Hey guys, welcome to the channel. Welcome back to another video. I just want to have a quick conversation with you guys. I normally don't go live during this time, but I saw an article and I said, you know what? I need to bring that article to my subscribers, viewers, and let's talk about it because it's going to be something that we need to be looking at in terms of investors, us being investors. So I said, let's have a conversation about it and let's just talk about the article that I read and saw. And so I'm going to pull that up real quick, guys, and just have a conversation about it. Um, Let me know you can hear me real quick when you come in here, guys. And let's see here. Give me 2 seconds, pull it up. Hope you guys are having a wonderful day. Good to have you. I see we got some folks checking in. Charlotte, North Carolina's checking in. James and Jay World, good to have you. So I just want to bring up this article real quick because I think we need to be aware of these things, guys, as we are investors and as we are concerned investors about what's going on with the stock market, with the economy, etc. So let me grab my screen real quick and pull this article up. All right, so and let's see if I'm up there. Let's see here. I think I'm there, right? Hope you guys are having a great day. Let's talk about it. Let me go ahead and make myself a little bit smaller here so we can make that article as big as possible. So, this article basically talks about, guys, will the stock market crash in 2024? Six risk factors. And so, there's some things going on in the economy that we need to be aware of as investors, as retail investors. Like we're not the big Fannie Mae and Sally Mae, and we don't have billions and billions and trillions, but we still have our money, right? Our 20 and 30 and 50 and 80 and $500,000. It feels like a billion to us because that's the money that we're going to use to retire on, right? So we need to know what's happening out here. There's some red flags in the economy, and I want to talk about them real quick on this quick video. Let's see here. So I'm just going to run down here and start looking at some things in this article that I want to share with you guys. And I don't know really how to make it bigger, but stocks are up 8.8%. We know that the stock market's doing well. We look at how the stock market's doing right now, today, ending the week, doing pretty good, right? Stocks are up for the year thus far, almost 9% through a couple of days ago, right? And it's measured through the S&P. But some investors are inching towards the sidelines amid worrisome economic news, a slowdown in economic growth and a softening of the labor market, which the article talks about, and I'll talk about that here. Economists call this a scenario of stagflation when you have this slowing economic growth, a softening labor market meaning that unemployment is creeping up a little bit, right? It's not so tight like it was. It's creeping up and rising core inflation. Some of them call it stagflation, right? Right. So in late April, like a few weeks ago, right, the U.S. Commerce Department reported the first quarter GDP, and it was the first reading of the GDP for this year. And the first reading for the GDP for this year, for the first quarter, happened in April. The second reading for the first quarter comes in May, and then the third and final reading, once all the numbers come in and they make all sense of it, it'll come in June. But the kicker is that it's down 1.6%. The GDP was only at 1.6% growth, which is way, way slower than the 3.4% GDP growth for last quarter of last year. So there's been a really strong pullback on the growth of the sales, the final sales. That's what GDP is, the final retail sales of goods and services across the country. At the same time, core U.S. inflation soared. They say soared. It raised a little bit to 3.7% in the first quarter of this year, right? And we was only expected to have a 3.4% increase this year. So, and that's up 2% from fourth quarter of last year. So inflation is sticking around. And we can tell it's sticking around because we see high prices sticking around, right? Year over year, raise in prices is sticking around. So it goes on to say rising inflation and slower GDP have thrown a wrench in the Federal Reserve's plan to cut rates, which is bad news for stocks. I know we're looking good. This is why you don't want to be too high and too low when you're looking at the stock market, looking at your investments. Because if you're getting real high and saying, oh, everything's great, wonderful, we're all up in the stratosphere, yay. What happens, guys, is that we don't understand some of the underlying factors that's going on behind the scenes, right? Behind the scenes, it ain't really all that great news based on the big picture of the economy, right? So I'm going to continue to read and go through this article real quick. Now, the stock market may be running out of gas as a threat to the 1970 stagflation. I don't want to read about the history, but I want to talk about the factors real quick. All right. So here's some of the factors that they mention in the article just from yesterday about why we could be looking at a potential stock market uh, uh, decrease coming up soon, right? Potential stock market crash that we need to be aware of as investors, guys. I haven't even looked at the chat. As you come in, hit the like button for me, guys. Hit that like button for me so we can get this quick video out to as many people as possible. Charlotte, North Carolina, Mrs. Moore checking in. Good to have you. Maddie checking in. Happy Friday to you from Quebec. Southern California is here. We got Tempe, Arizona in the house. Greenville, North Carolina. We got them from all over. Great. Looks great. Excellent, excellent, excellent. All is great. Florida boy 727. All right. So in terms of the article, though, it talks about first high inflation. One of the most significant risk to the potential sticky inflation is the potential sticky inflation that I just talked about, right? Sticky inflation means that the rates are going to continue to stay high in terms of our federal funds rate, right? Inflation readings to start the year have surprised to the upside with month-over-month core CPI. CPI keeps energy and food in it, averaging 0.4% during the first 3 months of the year. This equates to a 3-month annualized core CPI of 4.5%, right? If they take those first 3 months and they drag it out for the whole year, that's a 1 year real annualized of 4.5 for CPI, which is not incredibly high, but it's way, way higher than they want to see for the CPI, right? So that's something to think about. In conjunction with the hot inflation prints to start the year, yields have turned higher. So our bond yields have turned higher as well. So things aren't looking good for inflation, right? And that was some of what the worry was in terms of the Fed trying to, maybe lowering cuts too soon. They don't want to do it. So inflation is sticky and sticking around. Talks about some rising protectionism. Wealthy countries are hunkering down economically. Any rise in protectionism, increasing terror. Why are they hunkering down in protectionism? Because of what we see going on in terms of the Middle East, Ukraine, Russia, all these hot spots taking place. And so you see a little bit of protectionism going on with big countries and rich countries. And then, of course, the Fed's response. Now, the Fed, if you guys remember, and you probably do, just a few months back, the Fed was saying, well, we're looking at some cuts, and all the experts were saying we're looking at 5 or 6 rate cuts this year. That ain't happening. We're almost halfway through the year, and we see that is not taking place, right? So another big risk in 2024 is that market participants continue to underestimate the resolve of the Fed to tame inflation decisively. So each time the Fed loosened monetary policy too soon, it weakened its credibility and allowed increasingly high inflation expectations to become entrenched in the economy. Basically, the Fed is saying, okay, we don't want to act too soon, right? That's another issue in terms of what may happen in terms of ultimately the stock market, right? And our rates. The stock market miscalculates the Fed's determination to be hawkish and all that good stuff. So that's important. Now, that's important. And that's the Fed's response, and what the Fed does with the federal funds rate really makes a huge difference on individuals and businesses, right? Because when the Fed says, no, we're not going to lower rates, and the rates don't come to see, as investors, the stock market loves when rates come down, when the Fed lowers the rates, because when the Fed lowers the rates, what does that do for businesses? Businesses say, oh, rates are lower. Now I can borrow money as a business to go out and increase my business and make my business grow. I can borrow money at cheaper rates, but nobody wants to borrow at higher rates, right? Individuals or businesses. So the stock market usually responds favorably, goes up when rates go down. But now that rates aren't coming down anytime soon, because of the high inflation and other things, it means that we may see a pullback in terms of the overall, and we also see GDP going down, right? So we're seeing this pullback, and I'm saying for you as an investor, you need to brace yourself, right? And get ready. Not in a bad, I don't want to scare you, but I'm saying you want to get ready for the potential that rates are going to be remain higher for longer, and the stock market won't be seeing that boost that we may have seen in the past, right? We may see the stock market pull back, right? As GDP lowers, potential recession. Like, you have to kind of do a little bit of interpreting of this stuff on your own. So the other thing is mega cap weakness, right? So large thriving companies with exposure to AI have dominated in recent years, which we know. We talked about on our live yesterday the fact that the Mag 7 is full of tech companies, right? And it says any sign of a slide by so-called Mag 7 stocks may drive Main Street investors to exit. And we know NVIDIA has been killing it, right? NVIDIA's performance in the first 3 months of 2024 has moved it to the third largest stock in the S&P. If I was having this conversation with you last year, NVIDIA was more like the sixth or seventh largest stock. It's moved up tremendously, right? And we've seen that in its share price go up as well. But it's been a large part of the broad rally, right? Should NVIDIA or other Mag 7 stocks begin to miss earnings estimates or issue weaker than expected guidance, it would likely generate a pullback. And what happens when the Mag 7 starts to pull back? The Mag 7 is like 30 the top 10 companies in the S&P makes up what 33% of the S&P. So when one or two of them begin to pull back, we've already seen Tesla drop out of the Mag 7, right? But if you get some others of these start to pull back a little bit, it could affect the entire stock market, right? Because of the heavy weight that they incur, those top 10, top 20 companies, right? And a lot of them are IT. Then the other big issue, and we saw some stories come out today about this, is falling consumer confidence, right? American consumers are losing confidence in the US economy, and any further slide could trigger a stock market stampede away on the sidelines, right? So in April, consumer confidence slid to its lowest level since mid 2022, according to a Conference Board report. That's right here. And I think I mentioned this yesterday, but that's important because consumer confidence drives or has an effect on consumer spending. We see GDP down, we see unemployment perhaps ticking up a little bit, softening up. We see all these indicators, and they have not yet trickled down to the stock market itself, but they may, right? It says confidence retreated further in April, reaching its lowest level since July of 2022 as consumers became less positive about the current labor market situation and more concerned about future business consideration or conditions, job availability, and income, right? So that's another indicator, something to think about, right? Then you have weakness in corporate earnings forecasts that could play a role as well, right? So, and at the end of the article, they give you a note to investors to stay calm and carry on. And that's kind of my note to you guys as investors as well. But I won't guarantee, but I'll say, listen, the stock market's going to crash, right? The stock market's going to, I should say, correct itself, right? Automatically. We don't have to wonder. We don't have to think. We don't have to think it's crazy. We don't have to know exactly, but we just know that it's going to crash and correct itself. And that's what, as an investor, this is what I try to do on this channel, is try to bring you guys kind of up to speed in some basic, regular old plain language, right? We can just have a conversation. Looking back at the chat, Florida, St. Pete, Florida, LA is in the house. Austria is in the house. Good to have you here. Somebody said, don't take away my SPY ETF. So somebody said, hurry up and let the crash commercial dollar cost average all. So the kicker, and let me read a few more of these chats real quick. Hey, salute to you, Alonzo Hall. But the kicker is for us, here's what we got to do. And these are signs that the next stock market crash is close. Okay. And what I want you guys to think about, and when I say stock market crash, we could substitute the word corruption or correction for crash, right? And the correction could be a small correction or it could be a large crash. But for us as investors, we just have to stay true to our investing principles. And what are our investing principles? Our investing principles are our dollar cost averaging, right? Where we stay in the market, we don't pull and run like a lot of institutional investors will do because they have billions to play with. So they'll pull their money from the stock market and they'll go park that money in cash, or they'll go park that money in cash equivalents or fixed assets like bonds or something, right? Where while the market is getting a negative 15%, they have their money parked in bonds getting 1% or 2%, as opposed to losing 15. This is why large investors, either large individuals who have, millions of dollars in the market, or large institutional investors, this is why they pull their money from the market and then they go park it somewhere else and put it back in the market later when the market is about to do well, right? Now, for us, you could try to play that game if you want, but large institutional investors, they have whole groups of people. They have 50 people, 30 people, 20 people in their department who's monitoring this on a regular basis. And they know when to pull. They don't know, but they have a much better idea, much more informed idea of when to pull their money from the stock market to go plug it into bonds, to go plug it into cash or cash equivalents or something like that, because they have people doing this on an everyday basis. We don't have that luxury. So I don't want to tell you, hey, pull your money from the stock market and go park it over here and then put it back in. I don't have that. I don't know when to do that, right? I don't know. I don't have a team around me to figure that out like an institutional investor. So here's what we do as individual retail investors. We stay in the market. We stay in the market and don't try to time the market. We just dollar cost average in. This is what I do. And this is, I'm not a financial advisor, right? But I'm just telling you what I do. I stay in the market so that I don't have to guess and perhaps and take the risk of guessing wrong, which a lot of people do, right? They shift their money around, pull it here. They think that they're institutional investors, but then they're going to work every day and coming home from the 9 to 5, checking the markets or checking on their lunch on their phone. Listen, I don't want to play that game, because that studies have shown that that's a losing game, right? So I like to say, let's dollar cost average into the market as regular retail investors and not try to play the time in the market game, right? So we want to just have our investment plan, whatever our plan of action is. We want to commit to consistency over a long stretch, because over a long stretch, the market has proven to go up over the long stretch, right? And then we also want to make sure that we only have our money in things we understand. We want to have a diversified portfolio. Yesterday, and I'll link it to the description box below, but yesterday I did a video talking about diversification of your funds, right? And not just having everything, or maybe considering having S&P 500 ETF or index fund as a piece of your portfolio, as opposed to what some people do, have it as their entire portfolio, right? I gave you some really strong reasons why you want to consider having that S&P 500 not be the only place you have your money, but make sure you have it in other places as well as the S&P 500, right? And then, of course, risk what you can afford to lose, and also make sure that I like to reinvest my dividends. You don't have to if you don't want to. You can get your $30, your $50, your $500, your $1,000, $2,000 a month if you want. I like to put them back in, but the kicker is don't panic. Don't panic when we see the market begin to go down, the market begin to crash, because right now, as I just mentioned, there's some risk factors out there that we got to be thinking about, okay? In terms of inflation, in terms of the GDP, in terms of looking that maybe the stock market, stocks, and the market in general may be a little bit overvalued. It's not too bad, right? Again, we're working at about, 8 or 9% right now, about 8 or 9% in terms of year-to-date S&P 500 returns, right? So maybe it's not as overpriced as it was a couple of months ago when we were seeing some of those incredible, right, leaps and bounds. But just be aware. My point in this video is to just help you average, everyday, individual, regular investors be better with your money, manage your money better, grow your money, understand the stock market, understand some of the economic conditions that are happening around us, so we're not thrown off guard. We're not. Sometimes you watch Bloomberg TV on your TV, or you read an article and you don't quite understand everything in the article. But I just want to break it down to you guys in common sense, plain language. Let's see. Somebody said, time the market, beats trying to time the market. Yeah, time in the market, beats trying to time the market. Absolutely. Let's see here. $100 in FSMAX. Nothing wrong with that. Let's see. Somebody said Vanguard predicted a slowdown in the market in 2024. They did predict that. Absolutely. So diversification and consistency. Dollar cost average, right? And listen, when the market does crash, don't get panicked and start running and pull your money out and run the other direction. No, because what happens is with most people, when they start panicking, they watch the news and they watch the economy and they watch the stock market, they panic. Guess what happens? They sell instead of buying low and selling high, right? They end up buying low and selling low, right? They end up selling at the wrong time when you're trying to get out of the market. And then guess what? You don't get back in the market in time to realize some of those really high increases that happen right after a crash or right after a lull or right after a correction. You're not in the market because you don't know when. You don't have a team of 20 people helping you get back in the market and timing this stuff. So don't do it. Stick in there. Hey, quick video, guys. Do me a favor. Smash the like button. I got some good stuff in the description box below. Check out some free stuff there. If you got a question, drop a question. Share the video with somebody who you know is in the market, who's investing. Share this information out there with them, guys. Let's see here. People should sold their shares already and stop trying to play that game. Too much. Too much, as they say down south. All right. Listen, guys, appreciate you being here. Check out any other video I have down in the description box as well. And thank you so much for showing up. Appreciate you guys being here. I will check you out. Be back on here tomorrow, 11 a.m. Come back and visit. If you're not a subscriber, go ahead and subscribe to the channel, guys. Hey, I'm out of here. The best person to take care of the old you is the young you. Take good care of yourself and take care of other people. Until the next video, peace.